Okay, well, welcome everyone to today's session. This is our quarterly State of the Markets report. Today, we're just going to recap what happened in the first quarter of 2022 and then talk about the outlook moving forward for Q2 and beyond. I know for many, when we did our first session earlier this year, we kickstarted the year with a little bit of a bumpy start. A lot of people still relatively optimistic with the reopening of the economy, the reduction in COVID cases, lifting of mask mandates, increase in economic activity. And as many of you may know, that's hasn't exactly played out the way that I think we all had in our heads. But we'll talk a little bit about why today and then what to expect moving forward, what to look forward to through the rest of the third quarter, Q2 into Q3, and then through the end of the year. So for those of you that attend these on a regular basis, I always like to start it off with a little bit of keep it a little lighthearted. So if you remember from the first quarter of the year, we were all I think relatively excited about what was going to be happening in the markets potentially in 2022. And I think a lot of us now, being through the first quarter of the year and seeing the result, share the sentiments of our friend Jim Halpert here. And we're all asking the question, what is going on? Let's take a look at what happened in stock market index performance over the first quarter of 2022. So the major U.S. markets all down up until the 30th of March or 31st of March. We will review that and kind of give you a snapshot of where we stand today, because some of these numbers can look very different. But at the end of the first quarter, Dow Jones Industrial Index was down 4.1%, S&P 500 down 4.6%, and the NASDAQ Composite total return was down almost 9%. Looking around at the rest of the world, some of your developed countries, Europe, for example, still down more significantly than the United States. And then we see that emerging markets down probably, as with the exception of the NASDAQ in the United States, the biggest loser around the world, down almost 7% quarter to date. So not a lot of bright spots in the first quarter when we look at the market as a whole. But let's break this down a little further and look at the different sectors of the United States market in particular and see, what did better than the broader indexes. So when we look at this in Q1, the darling of the ball, so to speak, was the energy sector. And specifically commodities. And we all felt that oil and gas prices increasing, utilities also rising. So a result of inflation, a supply and demand issue, a reopening of an economy, increased demand, but some issues with supply. What we see here is that there were two relative bright spots in the rest of these sectors when we look at consumer cyclicals and defensive, all down in some way, shape, or form, some less than the index itself. But we also see that consumer or communication services and technology were big drivers, especially when we saw what we see from downturns in an index like the NASDAQ Composite. So a few industries or sectors that performed a little better than others, but not a ton of positive growth around the market as a whole. We saw that in the US as well as abroad. So what we can see here is a shift in different asset classes when we look at trailing returns. So if we look at year-to-date totals as of the end of the first quarter, commodities up 33%. So a pretty big number. Commodities as a whole had been, as you see, if you go all the way to the right, bottom right-hand side of that chart, the 10-year total return had not been in favor for quite some time. But what we're seeing from this chart is that in recent history, commodities have actually been the biggest gainer. So, this is a case we'll get into a little bit about investment philosophy and diversification. But what you'll see is a change in dynamics in terms of asset classes in the market. So, in certain periods of time, some are going to be better than others. We see over the 3, 5, and 10-year total return, U.S. growth, The S&P 500 has been towards the top of that list, but what you'll also see in recent history is that U.S. growth has actually been, in this particular asset class breakdown, has been the worst performer. So it's a little bit of a shift. What you can see is that, again, not very many asset classes, including bonds, which traditionally have been a safe haven for investors in the event that the equity markets don't perform as well. So why is that? One of the reasons is rising interest rates. So this chart is a good example of what interest rates have been doing, especially in recent history. One of the things that you'll see here is that in the first quarter, there was a lot of action in the yield curve. Treasury rates rose across the board. And so, much on the short end of the yield curve has flattened almost to the point of inversion. So if you watch any financial news, you'll see occasionally they'll talk about the idea of a yield curve inversion, why that could potentially be a bad thing. That actually has happened in recent history. The market actually rallied after that yield curve inversion, but this is something that many are going to keep an eye on long term. Sometimes people use this as a barometer for long-term market outlook, for example. Thinking that long-term economic growth, they may be a little bearish on that if short-term rates are basically almost equivalent to 30 years. So if we look at the difference between a 10-year and a 30-year treasury rate, not much of a difference these days. And that, has to do with Federal Reserve, for example, taking a more aggressive policy on trying to squash inflation and raising interest rates at a much quicker rate. So that leads us into just taking a look at some of the macroeconomic data. So when we look at the U.S. housing market data in the beginning of 2021, when we started this year, we saw some of the lowest 30-year mortgage rates and the highest number of mortgage originations almost in history. So since then, obviously, I think we all know that mortgage rates have headed higher. This has led to mortgage originations going down. But in addition to that, that's cooled off the refinance market pretty significantly. Now, rates that people had gotten a couple of years ago, there's no inherent benefits or refinancing out of that. We have seen other indications of growth in building permits, housing starts. We've also seen the National Home Price Index increase. So those are things that, typically when we see rates rise, we see that home prices tend to have an inverse relationship or an opposite relationship where they tend to go down. We haven't seen that again. Going back to the conversation of supply and demand, the housing market still relatively hot from a price perspective because of inventory and also a shift of people moving out of cities into other areas. And so we're seeing a net effect of that is not necessarily conventional to what we would think, but is something that we are certainly going to keep an eye on as time goes on and as interest rates continue to rise, in particular with 30-year mortgages. So the other thing we've been looking closely at is the strength of the U.S. dollar. So the U.S. dollar to euro, to pound, to sterling, Japanese yen, the exchange rates have all increased to 52-week highs based on the Q1 2022 data. We saw that the one exception to that was in China. The exchange rate, continues to gain strength against the U.S. dollar. That's a function of how they manage their currencies and specifically in relationship to the U.S. dollar. But what we are seeing is an increase in strength as far as exchange rates are concerned in the U.S. dollar to some of their counterparts and some of their key trade partners. So as far as U.S. trade balance is concerned, this slide actually shows us the activity between the United States and its key trade partners. What we're seeing is that the balance between U.S. trade goods and services has actually reached new all-time lows. So we see that US imports continue higher than pre-pandemic levels. We see that exports also returned and actually exceeded pre-pandemic levels. And then the chart on the top right shows the divergence of trade imports versus exports. And we see how that led to, actually, when we look historically speaking, the lowest US trade balance ever recorded. So what does that mean? Us as a country, in terms of the United States, we traditionally have one of the largest trade deficits of any other country around the world. We certainly import much more than we export. What we're seeing is a balance in that. We're actually exporting to some of our trade partners more goods and services. And so I think probably a heavier weighting on goods versus services, with the exception of maybe Mexico. The only place where we saw a pullback in that, as far as exports are concerned, is to China. A number of different reasons why, but COVID and the re-emergence of COVID in China has played a part in that, as well as ongoing trade negotiations about imports and exports with China leading back to the previous administration. So we're seeing more of a balance in trade in the United States, and what we'll be keeping an eye on is seeing how that's going to affect the economy in the short term through the end of this year. The big topic of conversation right now, I think everyone is talking about, is inflation. It's on the news, regular news cycles, financial news cycles. A nice little quote that I found from Sam Ewing, since we're baseball guys here at StatonWalsh. Great description of inflation. Inflation is when you pay $15 for the $10 haircut that you used to get for $5 when you used to have hair. At the beginning of this year, a big question that we asked and that we talked about in our presentation was, is inflation in the United States, is that going to prove transitory, or is it going to be structural? The term transitory got thrown around a lot. Chair of the Fed threw it around a lot. They felt that much of inflation was transitory. What we're finding is that some of that is true in some areas of the economy, and in others, there may be some particular components of inflation that might be a little more sticky. And so when we look at the inflation numbers as a whole, the U.S. inflation rate, based on the Q1 data, was over 8.5%. So it spiked pretty significantly in Q1, and it's actually the highest inflation rate since 1981. Actually averaged around 2.31%. So you see that average there on the middle of the chart, but we see a spike, obviously, in recent history to 8.5. So it's a cause for concern for many investors and many consumers trying to figure out, how far will my dollar go? What areas of the economy are mostly affected by that? And so that's what our next slide is going to cover, is just the components of inflation. So you'll see there that we have a few different categories that make up inflation for U.S. consumers. And so we have energy, new and used vehicles, food. There's an other category which is a little bit more comprehensive. We talk about restaurants, hotels, transportation, travel and leisure, and then the big one, shelter. And so what you'll see is that as inflation has increased, there are some components that we see a much larger bar than we had in the past, and some that we think might be a little more sticky. Things like shelter, for example. So when we talk about rents and primary residence costs, those are things that many economists believe are not going to be transitory in nature, that some of those costs are actually here to stay. The same may be true for travel and leisure industry as well. Where we've seen inflation that many still believe is transitory is going to be things like energy and food. And these are just supply and demand issues at the end of the day. It's about an increased demand in an economy that has reopened for the most part. but not having the ability to produce at the same level that demand is increasing. So, a lot of those top three categories, when we talk about food, some are directly related to one another as well. When we talk about energy, oil and gas prices, the transportation of that food to grocery stores, the cost of that transportation has increased. The production of that food has decreased. New and used vehicles, same issue. We're talking about a microchip shortage that has put the production of new vehicles behind, in many cases months, if not up to a year for some manufacturers. So all of these things, while transitory is taking on, transitory as in temporary, but not as short term as maybe we thought previously when we kicked this year off. So how does all that translate into investment outlook for the rest of 2022? So we talked in the first slide kind of what the Q1 data was. Now we're looking at where are we as of April 22nd, 2022. So this was released. If you follow our weekly market insights, we send out emails, just kind of update where the market is at any particular point in time. And so at the beginning of this week, when that went out, this chart was included in that email. And so what we'll see is that the Dow Jones Industrial Index is down almost 7% to date. Year to date, we have the S&P 500 now in double-digit loss territory, and the NASDAQ now at 17.93%, and then the MSCI EAFE. So looking at the rest of the world, down almost 9%. So pretty significant changes over the last month. At the end of the first quarter, we saw a little bit of a rebound in the S&P 500 specifically. And what we've seen is that over the past few weeks, we've had a little bit more of a pullback and a little bit of a seesaw effect. We go back and forth day to day, even intraday. We see some really big gains and the market finishes in negative territory and vice versa. What we've also seen is that the US 10-year note is up year to date 1.38% and closed at the end of last week at almost just shy of 3%, 2.9. So all of that being said, believe it or not, there are some reasons to be optimistic about the future, and here's why. One reason in particular, the consumer in the United States is in good shape. So when we look at consumer balance sheets and we look at debt service ratios and personal savings rates, believe it or not, many consumers are still relatively strong from a balance sheet perspective. They're flush with cash. And some of the reason is that savings flows increased when our economy was shut down. Some people were able to continue to work remotely. We're not affected necessarily in the same way by COVID. And so because of that, we weren't able to spend in the way that we traditionally had, which is actually created a net excess of savings on many households' balance sheets. So we talked a lot in previous presentations and throughout the pandemic of pent-up demand. And what we're seeing and what shows us a reason to be optimistic is that consumers still have relatively good deposit balances. They're not overextended as far as an assets to liabilities perspective, and they have plenty of cash available to spend. So, relative to what happens over time with inflation, what we may end up seeing is that spending will increase, which will obviously create stronger economic conditions for many sectors, especially the ones that have been greatly affected by a closed down economy, and potentially seeing a carryover of lower debt service ratios into the future, especially in comparison to some years past. Other reasons to be relatively optimistic: job market and wages are healthy. So when we look at unemployment or initial jobless claims versus available job openings, we're seeing that unemployment, the rate as a whole, is relatively low. Right now, the job market is pretty hot. I think there are many places that are trying to hire or trying to acquire new talent, and the data supports that. So right now, from a job perspective, the job market is strong. And what we're also seeing is that the annual changes in wage levels have actually gone up. So some data from the Atlanta Fed wage tracker shows that increase is around 4.5%, which, as you can see from years past, is a pretty significant jump when we look at even last year. Almost a 1% jump over that, actually a little bit more than a 1% jump during that same period of time. So inflation is going up. We're not seeing wage increases at the same rate at this point. We're not seeing interest rates. We're not quite to that equilibrium yet. But in the event that some of that inflation that we talked about is transitory, what we'll see is that once we get a little bit closer to that equilibrium, and things normalize potentially to the norm, which the U.S. Federal Reserve estimates they would like to see around 2.5% long term. As that happens, there are reasons to be optimistic and bullish about the market as a whole. Another reason to be relatively optimistic on our outlook is that history has shown us that markets often look through geopolitical events. So the biggest one that most are paying attention to is Russia and Ukraine conflict. Relatively insignificant impact when we talk about the amount of GDP that's really tied up in those two economies. So if we look at the rest of the world, how much product or services is exported to those countries. For most in the United States and abroad, with the exception of some countries in Eastern Europe, surrounding countries specifically, it's a minimal economic effect. So what we're seeing, I think, is right now a reflection of investor sentiment. It's investors voting with their dollars. But long term, what we see is that investor sentiment changes in a good way, even through some of these geopolitical events. And so you'll see so many examples of that. And you could see the fluctuation in the market during those periods of time. But ultimately, where we started and where we finished has been increasingly higher. So that gives us some cause for optimism as well. One question that we get pretty frequently these days from investors is questions like, should we consider maybe keeping our cash on the sidelines? Should we not get into the market? Should we get out of the market? How do we time this to be effective and efficient with our portfolios? The real answer to that question is it's hard to say. There's a lot of data out there that tells us that we can't effectively time the market. It's impossible. And there's, opportunities that can be missed even as in short periods, like 10 days, for example. Missing 10 good days of a market cycle could cost you significant amount of rate of return. In this particular case, what we're showing you is that in the inflationary environment that we're in right now, what's the cost of timing? What's the cost of keeping cash on the sidelines? And so what you'll see is that blue line, the income needed to beat inflation. In years past, there's been many instances where that's happened, your income earned or your interest earned on savings accounts. What we've seen pretty much over the past decade is that savings accounts pretty much pay next to nothing. And we've seen this pretty wide spread of inflation or income needed to beat inflation versus the rates that we're making on those accounts. So what does that mean? Effectively, you're losing money just the same as if you were to put it into the market. And in this case, let's assume in 2022, the savings rate is 0. Your current rate, what you would need to outpace inflation, is about $6,400 on 100,000, or let's call it 6.4%. So that's a loss in spending power on that dollar of 6.4% over time. So that's something that we need to consider when we're talking about how much cash to keep on the sidelines, and also understanding the purpose of that cash. Moving investment assets in and out of the market, trying to time it, trying to be risk on and risk off, we've seen traditionally just doesn't work. And we've also seen that it's not necessarily something that you have to do in order to achieve a good result. In the short term, it's painful, certainly. But in the long term, when we talk about things like beating inflation and beating the need for education inflation, and then when you get into retirement, one of the most important pieces of this puzzle is medical care inflation. One of the biggest risks to retirement income that we see when working with clients. So these are all things to consider. Ultimately, what you're going to want to do is keep an appropriate amount of cash on hand that you need for emergencies and opportunities. But when we talk about our risk on assets, or the assets that are invested in a traditional market environment, you're not going to want to take them in and out of the market, putting them into investments and then into cash, because ultimately there is a cost to that timing, and that's lack of exposure to potential upside, and losing spending power on those dollars as a result of inflation. And when we talk about investing, we focus a lot on time diversification and really just volatility in general. One of the things that you have to consider is that year to year, you can see on the left side of that chart, there's a huge spread that what can be achieved in stocks alone. What you'll see over a 20-year rolling average is that the average total annual rate of return on stocks is about 11.5%. But in any 1 year given period of time, you can be up 47% or you can be down 39%. That's what we mean when we talk about volatility in the stock market specifically. The same is true for the bond market. We've seen that a little bit this year, typically a safe haven, like we mentioned, for conservative investments, and it hasn't yielded the same result that we would have traditionally or conventionally thought. Much of the bond market has actually lost value. And so you can see year to year, there's a pretty wide spread when we talk about volatility. But as we go out on our time horizon, what you see is those spreads tend to tighten, and your average rate of return is still relatively good, but the chance of you losing significant amounts of money over a rolling, we talk about 5-year, 10-year, and 20-year in the context of this chart, and this is since 1950, pretty low numbers there when we talk about even over a 5-year rolling average, down 3% in an all stock portfolio. And you see that goes down and even into positive territory when we talk about 20 years. So what's my point in saying all this? That volatility in any investment environment is normal. Now, understanding the amount of risk and the appropriate risk that you need and want to take is also an important piece of the puzzle. But volatility is normal. Risk of loss is normal. Losses in any given year are also normal, but keeping perspective and understanding the purpose of that money. And when we talk about risk on and risk off, how much of that money do you want to put at risk, with the understanding that if you have a longer term perspective, and even in the context of this chart, longer term could mean 5 years, not necessarily 20, 30, or some infinite time horizon, but things that are just over the horizon. So I think keeping context is important, especially in an environment that we're in today, when we talk about how we're investing money, the volatility that exists, the emotional reactions that occur on a daily basis in the market, investors getting in, getting out, and you see that I mentioned the seesaw effect of the market. So maintain perspective and discipline. Those are going to be the two most important tools that you have in your toolbox to get through market environments like these. And ultimately, there's always going to be light at the end of the tunnel. And it's been true in recent history when we talk about recessions in the early 2000s, 2008, 2009. And we've seen the result of that. And it's going to be true for the next cycle as well, in some way, shape, or form. It's always going to be slightly different, but I think just maintain your perspective, understand your goals and your risk tolerance specifically, and more importantly, maintain discipline and conviction around your overall investment philosophy. So with that, I'm going to turn it over for some questions.
Ryan, we have one here in the chat. Ask, can we discuss the reasoning for the major impact to the communication industry, trying to understand how supply demand or global implications are impacting that? For example, semiconductor chips, 5G scale, etc.
Yeah, that's an interesting question. So in the context of, if I go back to the slide that I believe you're referring to, in the context of this slide, I think the effect, and when we talk about communication industry as a whole, sorry, just want to get back here, the communication services, and the downturn in that particular sector, I think there's a lot of different reasons for that. Some of which you mentioned, chips, semiconductor, supply and demand issues, increased demand, decreased supply. More specifically, though, I think it's some of the technology around communication services, and not just specific to things like 5G. I think that there are other things that were quote unquote our pandemic stocks. One technology that we're using today, Zoom, for example, they were big players during a period of a shutdown economy. When we talk about in the context from an investment perspective, why they're being negatively affected, I think that consumer sentiment just isn't there anymore. They were probably a little bit overbought, overheated to some degree, and so now we're just seeing a normalization of those individual stocks themselves. As far as the industry itself, being in I guess a negative position, I don't necessarily think that's the case. I think this is more of a situation where investors are voting with their dollars. I say that, I use that phrase a lot, but ultimately that's what the market is. It's a reaction to the environment that we're living in, and so people are rotating from sectors that had been really, really good for a period of time, and they're rotating out of those sectors, both institution and retail, into other investment vehicles that they think better suit their needs. And sometimes when we talk about institutional and retail and the difference between the two, some move a little slower than others. So what we're seeing is some bigger sale activity happening in some of those sectors, and they're repositioning them to energy, utilities, because that's where the sentiment is right now. That's where they feel like they're going to get the most bang for their buck. So I'm not sure if that completely answers your question. I think we can speak to it in the context of market environment, why the market is reacting the way they are to this particular industry from a stock perspective, for example. As far as the economics of those industries and what's going on, I think that this is not a necessarily a reflection of that as much as it is a reflection of consumer sentiment around maybe some stocks that they felt were overvalued, for example.
Another question, Ryan, is do you think the market will end in the red this year, or do you think that there's a chance it could end up positive by end of year?
I again, reasons for optimism, we talked about a couple of those. I think there's still ultimately a possibility that the market finishes in positive territory. I think a good possibility. There are things that can continue to affect that if inflation remains persistent. Now, keep in mind, for those that have invested over a long period of time, you may already know this, but for those that don't, one of the only asset classes that has consistently beat inflation in history has been stocks. So if you want to talk about asset classes that have a good opportunity to grow or outpace inflation, investing in the market is going to be a good way to do that. Now, will the market finish in positive territory by the end of the year? I think it's a good possibility. It's something that can be affected by what I mentioned, inflation. The other thing is geopolitical risk. Like there's always we talked about this a lot when we talk about trying to predict the future. It's really hard to do, but we can predict within a 95% probability range. So this kind of just gets into general math, and it goes back to my last slide that we talked about. We know that in any given year, the market, and let's use the stocks, for example, it can be up 47% or down 39%. So we know with a 95% level of certainty that it can be up that or down those two numbers. Now, why we say 95% is because the other 5% are the unpredictables, so to speak, the things that we can't plan for, the things that we can't control. Corona, COVID-19 in March of 2020, something that, shutting down the economy, and changing the way that we work and live. That's something that no one can predict. You can't hedge against an event like that. The same would be true for things like Russia and Ukraine, potential wars and other conflicts around the world. Those are things that are ultimately, as investors, are out of our control and will in some way potentially negatively affect the market in the short term. But when we talk about the predictable factors, and we talk about the economics of what's going on, everything still looks relatively strong and positive. There are some things that are in contraction mode, but most things are, most parts of the economy are in good shape, growing. Our leading indicators, for the most part, are relatively good, especially when we compare them to other periods of recession, like we look at pre-2008 or into 2008, 2009, where we stand today versus where we stood at that period of time, very different. And we're seeing some pullback in certain areas, but not in any significant way that's cause for concern. So when talking about investments, our personal philosophy here is have that conviction and discipline to stay the course. I think that there is a good possibility that the market can finish up by the end of the year. And we have a chart that we use in other presentations that actually is a good depiction of that talks about intra-year declines year to year. And there have been many years and many instances in market history where the S&P 500, for example, was down double digits, even into 19-20% range down for the year, and had actually finished in positive territory, in some cases double digit positive territory. So those are pretty significant swings, and that can happen even in a 3 to 6 month period of time. So my point in saying all that, I think that the assumption that the market could still finish in positive territory by the end of the year is certainly not out of the question.
One more just came in, Ryan. Any asset classes that people should be allocated to that you think that has been underperforming that might be outperforming in the future?
Well, if you asked me that question 6 months ago, I would have told you commodities with my crystal ball. No, the good answer to that question is to maintain some level of diversification. Now, how can we do that? I think there are sectors of the market that have been relatively underperforming for a long period of time. One in particular is when we look at the rest of the world in comparison to the US markets. There's been an inherent US bias amongst investors for a really long time. But we've seen, interestingly enough, we tend to have short memories as investors, and we don't remember, different periods of time where it hasn't always been this rosy when we talk about the S&P 500, for example, as a whole. So my favorite example of that is, what we call the lost decade, which was 2000 to 2009. That was basically a 10-year period in the markets where the US S&P 500 index was flat for a whole decade. It was down for 3 straight years in the beginning of the 2000s. Then it came back. Then it was down again 2008 through 2009. And cumulatively, if you would put $1 in on January 1st of 2000 and you looked at your statement at the end of 2009, it didn't look very pretty. And you would have had probably the same reaction as our GIF in the beginning of the presentation. Why is that? And it's just because the US market as a whole was flat during that period of time. There was a couple different recessions that we went through. And my point in giving this context is that the rest of the world during that period of time, so Europe, developed, international, emerging markets, international, was up 225% during that same 10-year period of time. So it's impossible to time what 10-year period you're going to be in. It's impossible to predict, but we do feel like there's a tremendous amount of value in investing overseas. And where there are instances where obviously that hasn't worked out in recent history is if any investment assets or any funds that you owned had exposure to Russia and they got rid of that exposure, probably after that particular piece lost a little bit of money. But we do feel like emerging markets, the world ex-US, so the MSCI World Index, those are places where there's tons of opportunity to find value, because the US market has been on this unprecedented bull run for a very extended period of time. In order to find value within US markets, you're going to have to look at more risky asset classes like US small cap, mid cap. But we do feel like there is a tremendous amount of value in investing around the rest of the world. So to summarize that, I think maintaining diversification, first and foremost, is key. Don't try to rotate different asset classes and find the right time to be in one over another. I think the best thing that you can do, you can have exaggerated tilts to one or the other. So for example, maybe you only invested 10% of your assets in international at this point. You may want to consider increasing that percentage over time. And then having periodic rebalancing as well will also help enhance your rate of return over time. So there are a few. I think some have been really undervalued for a long time, like commodities, and now obviously they're outperforming everything else. But there are still opportunities to find value in the marketplace and still get some enhanced rate of return. It's going to come with a little bit more risk, but we do think that having allocations to some of those asset classes I mentioned, like emerging markets, small cap, and mid cap, not just your traditional S&P 500, US growth, US value, having a mix, it would be appropriate, and I think would be valuable for many investors who fit that risk profile.
So that's all the questions for right now. If anybody has any more, feel free to drop them in the Q&A or the chat. We'll give it a couple more minutes. And thanks everybody for joining in today.
Yeah, thank you, everyone. Appreciate your time, and let us know if there's any additional questions you have or anything that we can do to help. Feel free to reach out to us. We're happy to answer questions at any time, and we'll hang out here for a couple more minutes just to see if anyone else thinks of anything or wants to talk about anything. But if not, we will. Another question came in really quick. Will you be sending the recording? Yes, we will. So if you dialed in late or you didn't have an opportunity to take it all in, there will be a recording with the slides and our conversation today so that you can review it in your own time.